talking money today. Bank fees, savings goals, and some common misconceptions many Americans still have about their finances.
NerdWallet's Kate Ashford joins us with insights from their latest survey and how to get your money working smarter. Kate, welcome.
Hi, good morning.
All right, let's talk about fees here. We saw in your survey that 3 in 10 people believe it's impossible to avoid them. Is that true?
No, luckily that's not true. As long as you have an understanding of the sorts of fees that your banks are charging and take a few common sense steps, there are plenty of ways to avoid fees most of the time.
And what are some of those ways to avoid the fees?
Well, the most common fees people are facing are monthly maintenance fees, ATM fees, and overdraft fees. Most banks will waive those monthly maintenance fees if you set up a direct deposit or you keep a minimum bank balance. Overdraft fees, you can opt out of those, actually, if you don't want to pay the $30 to $35 that most banks will charge if you don't have enough money in your account. Or you can find a bank with a strong ATM network so you avoid ATM fees, or even find a bank that reimburses ATM fees.
Oh, okay. Well, how about savings, though? The survey found 43% of Americans believe money for long-term savings goals should go into the stock market. So is that a good idea?
Well, that almost seems reasonable, but at NerdWallet, our stance is that money for the stock market should be money you don't need for at least 5 years or more. For shorter-term savings goals, especially if those timelines are not particularly flexible, like you're saving for a wedding, we think there are better places to put your cash.
Would a better place be a savings account the old-fashioned way?
Well, we think people should put their short-term cash in a high-yield savings account, a money market account, or a CD, keeping in mind that CDs require you to keep your money in for a specific period of time, usually at least 3 months, and they don't allow ongoing deposits. You won't see the kind of returns you might see in the stock market, but at least when you need the money, you know it will be there.
All right. Well, 78% of people think that bank interest rates move exactly with debt interest rates. Is that true, or that's not the case?
Well, that's not completely false, but it's not completely true either.
Okay.
It's kind of a murky myth. The Fed rate that you hear about in the news is the interest rate that banks pay each other to borrow and loan money overnight. So as that rate goes up and down, that interest rate might get passed on to your savings account rate or your credit card interest rate, but it's not a one-to-one ratio. You might find that the Fed rate goes down and your savings account rate might go up. Mortgage rates might stay the same. So these rates are somewhat related, but they don't move in lockstep.
Oh, okay.
Now, Kate, is there one financial habit you think everyone should focus on this back half of the year?
Absolutely. At NerdWallet, we think everyone should have an emergency savings account. Aim to have at least 3 to 6 months of living expenses in a place that you can get to it. If that feels really daunting, start smaller. Start with $500, start with $1,000, something that could help you pay for a surprise car bill if it came up, or a medical bill that was higher than you expected. Make it a realistic goal and put aside a little bit every month until you get there.
Okay. Great advice. Thank you so much. Appreciate it, Kate.
Thank you for having me.
All right, thank you. And for more money talk, check out NerdWallet online.